Tomorrow morning, while most of America is still waking up, the Social Security Administration will begin processing what could be one of the largest payment batches of the month. For those expecting money, there is critical information to understand right now that could directly impact how much lands in your account. We are talking about deposits that could reach $2,400 or more for some recipients. However, what nobody explains clearly is that the amount you receive and the exact day it arrives depends on factors most people have never been told about. That lack of knowledge is costing thousands of seniors money they have already earned and deserve. To be completely straightforward, the Social Security Administration operates on a strict payment calendar based on when you were born and when you first started claiming benefits. Understanding this system is not just helpful, it is essential if you want to avoid financial surprises and ensure you are getting every single dollar you are entitled to. If you were born between the 1st and the 10th of any month, your payment arrives on the second Wednesday. Born between the 11th and the 20th, that is the third Wednesday. If your birthday falls between the 21st and the 31st, you are looking at the fourth Wednesday of each month. But here is where it gets complicated. Supplemental payments, cost of living adjustments, back payments for processing delays, and special one-time deposits can change these amounts dramatically. The Social Security Administration processes over 70 million payments every single month, each following a system carefully designed over decades. What keeps financial advisors up at night is that thousands of seniors are missing out on money they have already earned simply because they do not understand how this system actually works. When we talk about a $2,400 deposit hitting your account tomorrow, we are not just talking about your regular monthly benefit. We are talking about a combination of factors that include your primary insurance amount, any cost of living adjustments that have been applied, potential back payments if there were delays in processing, and supplemental payments you might qualify for based on your specific circumstances. Now let us get into the real mechanics of how tomorrow's payment batch actually works. The Social Security Administration does not just randomly send out payments. They follow what is called a staggered payment schedule. This schedule has been in place since 1987, when Congress decided that sending all Social Security payments on the 3rd of every month was creating massive logistical problems for banks across the country. So they split it up based on birth dates. If you started receiving benefits before May 1997, you are part of what they call the legacy group, and your payments come on the 3rd day of every month regardless of your birth date. But if you started receiving benefits after that cutoff date, then your payment day depends entirely on which part of the month you were born in. Tomorrow's batch is special, and there are additional payments being included that do not follow the normal schedule. The $2,400 figure we are talking about is not just pulled out of thin air. The average Social Security retirement benefit in 2025 is sitting at around $1,176 per month for individual retirees. But what makes this particular payment batch different is that we are looking at a combination of regular monthly benefits plus potential supplementary payments that some seniors qualify for, but many do not even know exist. Let me break this down in a way that actually makes sense for your wallet. If you are receiving the maximum Social Security benefit because you worked for 35 years at or above the maximum taxable earnings limit, and you delayed claiming until age 70, your monthly payment could be as high as $4,970 through choice. That is the absolute ceiling. But most people are not getting that amount. What we are seeing with tomorrow's deposit is something more nuanced. The Social Security Administration periodically issues what are called supplemental payments, and these can come from several different sources. First, there is the annual cost of living adjustment, which for 2025 came in at 2.5%. This means that if you were getting $1,800 per month in 2024, your payment automatically increased to approximately $1,845 starting in January 2025. But here is where it gets tricky. Sometimes the Social Security Administration makes errors in calculating these adjustments. And when they catch these errors, they issue back payments to make up the difference. These back payments can add several $100s to your regular monthly deposit. They usually come without much warning except for a notice in the mail that arrives either right before or right after the money hits your account. Another source of additional funds in tomorrow's batch could be related to supplemental security income, commonly known as SSI. SSI is different from regular Social Security retirement benefits, but many seniors receive both programs simultaneously. SSI is needs-based, meaning it is designed to help people who have limited income and resources. The monthly federal payment for 2025 is around $943 for an individual. If you qualify for both Social Security retirement and SSI, these payments are calculated separately and sometimes arrive in the same deposit, which can make your total monthly income appear much higher than your base Social Security benefit alone. The key thing to understand is that SSI payments actually follow a different schedule than regular Social Security. They typically arrive on the first of the month, but when payment dates fall on weekends or holidays, things get shifted around and multiple payments can end up hitting your account on the same day. Let me talk about something that hardly anyone discusses, but absolutely should: the taxation of Social Security benefits. Depending on your total income, you might have to pay federal income tax on up to 85% of your Social Security benefits. Now, before you panic, understand that this does not mean the government takes 85% of your check. It means that up to 85% of your benefit amount could be considered taxable income when you file your tax return. Here is how it works. The IRS looks at what they call your combined income, which is your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefits. If you are filing as an individual, and your combined income is between $25,000 and $34,000, you may have to pay income tax on up to 50% of your benefits. If your combined income exceeds $34,000, up to 85% of your benefits may be taxable. Now let us talk about the windfall elimination provision and the government pension offset. These are two rules that can significantly reduce your Social Security benefits if you also receive a pension from work where you did not pay Social Security taxes, which is common for certain government employees and teachers in some states. The windfall elimination provision can reduce your Social Security benefit by up to half of your pension amount. The government pension offset primarily affects spousal and survivor benefits, and it reduces those benefits by 2/3 of your government pension amount. These provisions are incredibly complex, and many people do not discover they are affected until they actually apply for benefits. Here is something else that is absolutely essential to understand about tomorrow's payment: the difference between your primary insurance amount and your actual benefit amount. Your primary insurance amount is the benefit you would receive if you claim Social Security at your full retirement age, which is 67 for anyone born in 1960 or later. But your actual benefit amount depends on when you choose to start claiming. You can claim as early as 62, but if you do, your benefit gets reduced by approximately 30% compared to waiting until your full retirement age. On the flip side, if you delay claiming past your full retirement age, you earn delayed retirement credits that increase your benefit by 8% for each year you wait up until age 70. Let me share something that financial experts know, but most regular folks do not. Social Security benefits can continue to increase even after you start receiving them, and not just because of cost of living adjustments. If you are working while receiving Social Security benefits before reaching your full retirement age, there is an earnings test that can temporarily reduce your benefits if you earn more than a certain threshold. For 2025, that threshold is $23,400. If you earn more than that, the Social Security Administration withholds $1 in benefits for every $2 you earn above the limit. But here is the good news: those withheld benefits are not gone forever. Once you reach your full retirement age, the Social Security Administration recalculates your benefit to account for the months when benefits were withheld, effectively giving you credit for those payments in the form of a permanently higher monthly benefit going forward. Another factor that can boost your payment is if the Social Security Administration discovers that your earnings record was incomplete or incorrect. This happens more often than you would think, especially for people who had multiple jobs or worked for small businesses that might have had payroll issues. The Social Security Administration is supposed to automatically update your earnings record each year based on what employers report. But mistakes do happen, and these adjustment payments can be substantial, especially if the error affected multiple years, or occurred during your highest earning years. Let us talk about survivor benefits because this is another area where people can see unexpectedly large payments. If you are a widow or widower receiving survivor benefits based on your deceased spouse's earnings record, you might be entitled to more money than you are currently receiving, especially if your spouse had delayed claiming their own benefits or had high lifetime earnings. Survivor benefits are calculated based on what your spouse was receiving or would have been entitled to receive. They can be as high as 100% of that amount depending on your age when you start claiming them. Many people do not realize you can switch between different types of benefits if it is to your advantage. Here is something about Medicare premiums that directly affect your Social Security payment. If you are enrolled in Medicare Part B and Part D, those premiums are typically deducted directly from your Social Security payment before it hits your bank account. The standard Part B premium for 2025 is $185 per month for most people. But if your income exceeds certain thresholds, you will pay an income-related monthly adjustment amount that can push your premium much higher based on your tax return from 2 years prior. Tomorrow's payment batch represents more than just money hitting bank accounts. It represents the fulfillment of a social contract that has been in place since 1935. You paid into the system throughout your working years, and now you are receiving the benefits you earned. So, make sure you know your payment schedule. Check your mail for explanation letters if amounts seem different. Review your Social Security statement annually, and do not hesitate to contact the Social Security Administration if something does not seem right, because this is your money that you earned. The staggered payment schedule was implemented to alleviate the burden on financial institutions that previously had to process all Social Security payments on a single day. This system spreads out the workload over several Wednesdays, ensuring smoother transactions and reducing the risk of banking delays. For those in the legacy group who began receiving benefits before May 1997, the consistency of receiving payments on the 3rd of each month provides a predictable financial routine. However, for newer beneficiaries, understanding the birth date-based schedule is crucial for budgeting purposes. It is also important to note that if your designated payment day falls on a holiday or weekend, the payment is typically issued on the preceding business day. This adjustment can sometimes lead to confusion, especially when multiple payments coincide. The cost of living adjustment is a critical component that ensures benefits keep pace with inflation. The adjustment for 2025 of 2.5% reflects the increase in the cost of living as measured by the Consumer Price Index for urban wage earners and clerical workers. This index tracks changes in the prices of goods and services, and when it rises, Social Security benefits are adjusted accordingly. However, the calculation is not always straightforward. For instance, if the CPIW increases significantly in a given year, the COLA can be higher, but if inflation is low, the adjustment might be minimal or even zero, as happened in some years past. Recipients should be aware that the COLA is applied automatically, but it is always wise to verify the new amount on your statement. Additionally, for those receiving SSI, the COLA is also applied, which means both benefits can increase simultaneously, leading to a larger combined deposit. Back payments often arise from situations where there has been a delay in processing a claim, such as for disability benefits or retirement benefits that were applied for after full retirement age. These payments can accumulate over months or even years, resulting in a lump sum that can be substantial. For example, if you were approved for disability benefits after a lengthy appeals process, you might receive back pay covering the period from when you became disabled to when your claim was approved. Similarly, if you delayed claiming retirement benefits and later applied, you might receive retroactive payments. The Social Security Administration is required by law to pay these amounts, but they often come in a separate deposit or as part of a larger monthly payment. It is essential to keep records of your application and correspondence to ensure you receive what you are owed. Supplemental Security Income is a program that provides financial assistance to aged, blind, and disabled individuals with limited income and resources. Unlike Social Security retirement benefits, which are based on work credits, SSI is funded by general tax revenues. The federal benefit rate is set annually, and states may add supplementary payments. For 2025, the federal rate is $943 for an individual, and $1,415 for a couple. However, these amounts can be reduced if you have other income or resources. When SSI and Social Security benefits are combined, it can create a complex payment structure. For instance, if your Social Security benefit is low, you might qualify for SSI to bring your total income up to a minimum level. Understanding how these programs interact is key to maximizing your benefits. The taxation of Social Security benefits is a topic that often surprises recipients. Many believe that Social Security benefits are tax-free, but depending on your income, a portion may be subject to federal income tax. The thresholds for taxation have not been adjusted for inflation in decades, which means more people are becoming subject to taxation over time. For married couples filing jointly, the combined income thresholds are $32,000 for the 50% level and $44,000 for the 85% level. It is important to plan for potential tax liabilities by setting aside funds or adjusting withholdings from other income sources. Some states also tax Social Security benefits, so checking your state's tax laws is advisable. The windfall elimination provision affects individuals who receive a pension from employment not covered by Social Security, such as some government jobs. The provision reduces the Social Security benefit by a formula that considers the number of years you worked in covered employment and the amount of your pension. The reduction can be significant, but it is capped to ensure you still receive some Social Security benefit. The government pension offset similarly affects spousal or survivor benefits if you receive a government pension. These rules are intended to prevent what is perceived as double dipping, but they can be harsh for those who spent part of their career in public service. If you are affected, it is worth consulting with a financial advisor to explore strategies to mitigate the impact. Your primary insurance amount is the foundation of your Social Security benefit. It is calculated based on your average indexed monthly earnings over your 35 highest earning years. Indexing adjusts your past earnings to account for wage growth, ensuring that your benefit reflects current standards. Claiming benefits before full retirement age results in a permanent reduction, while delaying beyond full retirement age results in permanent increases. The decision of when to claim is one of the most important financial decisions retirees face. Factors such as health, life expectancy, and other retirement income should be considered. For those who continue working, the earnings test may temporarily reduce benefits, but as mentioned, withheld benefits are later restored through higher monthly payments. Survivor benefits are a vital aspect of Social Security, providing financial support to families after the loss of a breadwinner. Widows or widowers can claim survivor benefits as early as age 60, but with reductions if claimed before full retirement age. If you are caring for a child under age 16, you may qualify for benefits regardless of your age. Survivor benefits can be up to 100% of the deceased worker's benefit amount if claimed at full retirement age. Additionally, children, dependent parents, and even ex-spouses may be eligible under certain conditions. Understanding these rules can help families secure the support they need during difficult times. Medicare premiums are deducted directly from Social Security payments for most beneficiaries. Part B covers outpatient services, and Part D covers prescription drugs. The standard Part B premium for 2025 is $185, but high-income beneficiaries pay more through IRMA. IRMA is based on your modified adjusted gross income from 2 years prior, so a change in income can affect your premiums later. It is possible to appeal IRMA if you have experienced a life-changing event, such as retirement or marriage. Keeping Medicare costs in mind is essential for budgeting, as these deductions can significantly reduce your net Social Security payment. In conclusion, the Social Security system is complex but designed to provide a safety net for retirees, disabled individuals, and survivors. Tomorrow's payment batch may include various components that boost your deposit, but understanding the rules and regulations is key to ensuring you receive all you are entitled to. Regularly reviewing your Social Security statement, staying informed about changes, and seeking assistance when needed can help you navigate this system effectively. Remember, these benefits are earned through a lifetime of work, and you deserve to receive them fully. Every detail, from your birth date to your earnings history, plays a role in determining your benefits. Taking the time to educate yourself and proactively manage your Social Security claims can make a profound difference in your financial security during retirement. So, as you await tomorrow's payment, use this knowledge to verify that everything is in order and to plan for a stable financial future.